In the high-stakes world of international finance, diligence is not just a standard procedure, it is the thin, fragile line between a triumph and a catastrophic failure. For the executives at a global banking titan, the deal seemed almost too good to be true. They were positioned to acquire a smaller, struggling financial services firm, an entity that, on the surface, appeared to be a sinking ship burdened by bad debts and poor management. To the board of directors, however, it was a prime opportunity to strip the company for parts, absorb its remaining assets, and solidify their dominance in a volatile market. They ran the numbers, checked the ledgers, and dispatched teams of elite auditors to pore over every single transaction recorded during the last decade. Every document seemed to confirm their hypothesis: the target company had lost its way, its value had plummeted, and it was desperate for a lifeline. They structured the acquisition with surgical precision, ensuring that the legal language shielded them from any obvious liabilities. The press release was already drafted, celebrating a strategic maneuver that would propel their stock prices to record highs. They felt confident, smug, and entirely in control. The acquisition closed on a rainy Tuesday in early November. The champagne was uncorked in the boardroom, and the executives toasted to their own foresight. They believed they had effectively bought a mountain of assets for pennies on the dollar. However, in the basement of the acquired firm's secondary office, a dusty, forgotten archive building located on the outskirts of the city, a junior researcher named Elena was tasked with the tedious job of digitizing files that predated the firm's digital transformation. She was not a high-level executive or a hotshot auditor, she was simply a diligent worker trying to finish her shift. While sorting through a crate of misplaced internal correspondence from nearly 20 years prior, she found a series of handwritten ledgers and internal memos that seemed entirely unrelated to the current business operations. At first, they appeared to be nothing more than mundane notes about early software development projects. But as she flipped through the yellowing pages, she noticed a pattern. The notes described the development of a proprietary algorithm designed to manage high-frequency trades in a way that defied standard regulatory oversight. It wasn't just a simple trading tool, it was a fundamental shift in how assets were valued, essentially creating a ghost ledger that existed parallel to the official company books. The documentation suggested that this wasn't a failed experiment that had been abandoned, but a powerful, highly successful system that had been intentionally buried to avoid tax scrutiny and regulatory interference. Elena felt a chill run down her spine as she realized the implications. If this system was still active, or even if its legacy data were to be exposed, the bad assets the bank had just purchased were actually part of a massive, sophisticated financial shell game. She pulled her phone from her pocket, took a deep breath, and sent an encrypted email to her direct supervisor, not realizing that she had just pulled a thread that would unravel the entire fabric of the bank's recent, multi-billion-dollar acquisition. She had no idea that the great deal was, in fact, a ticking time bomb. The supervisor who received Elena's email didn't hesitate. He wasn't a corporate sycophant, he was a former regulator who had joined the company to make a difference, only to grow disillusioned by the ivory tower arrogance of the new owners. He saw the potential for the truth to be buried or, worse, for the bank to be implicated in a massive cover-up if they didn't act immediately. He took the evidence directly to the oversight committee, but he was met with cold, dismissive silence. The bank executives, still intoxicated by their victory, viewed the discovery as an internal annoyance, a piece of legacy garbage that threatened to complicate their quarterly earnings report. They tried to suppress the files, ordering Elena to destroy the physical records and scrub the servers. But the digital footprint was already beyond their reach. Elena, fearing for her career and perhaps her safety, had already forwarded the encrypted files to an investigative journalist she knew from a previous life. Within 48 hours, the story broke. It didn't just leak, it exploded across the front pages of every financial publication in the world. The ghost ledger was not just a historical curiosity, it was a functioning mechanism that had been siphoning liquidity from the market for years. When the regulators finally came knocking, they didn't come to look at the paperwork, they came with warrants. The bank stock, which had been performing beautifully since the merger, began a vertical freefall. Investors, terrified by the prospect of massive fines and the looming shadow of criminal complicity, dumped their holdings in a panicked frenzy. The billions in projected value from the acquisition evaporated, replaced by tens of billions in market cap losses. The irony was suffocating. The bank had gone out of its way to ensure they were shielded from the target company's obvious liabilities, completely missing the hidden, systemic poison that was now coursing through their own veins. The final blow came when the regulators revealed the true scale of the impact. The ghost ledger had been used to artificially inflate the value of assets that were now being used as collateral for the bank's primary loan portfolio. Because the base assets were fundamentally worthless, or worse, illegal, the bank's entire balance sheet was essentially built on a foundation of sand. The government didn't just slap them with a fine, they placed the institution under intensive supervision, effectively stripping the board of their power and forcing a complete restructuring. The executives who had toasted their own genius just weeks earlier were now sitting in sterile interrogation rooms, trying to explain how they had missed the most important piece of paper in their company's history. In the end, the cost wasn't just measured in the billions of dollars lost in stock value or the massive legal settlements that would drag on for a decade. It was measured in the total disintegration of trust. The great deal turned out to be the ultimate lesson in corporate hubris. They were so focused on what they wanted to see that they became completely blind to the truth sitting right in front of them in a dusty basement. The bank didn't just lose money, they lost their reputation, their leadership, and their future, all because they ignored the one thing they should have valued most, the truth, no matter how inconvenient it might have been to their bottom line.